What the heck is shorting a stock? How do you do it? And isn't it a bit un-American? Hi, everyone. I'm Mark Lichtenfeld, Chief Income Strategist with the Oxford Club. Welcome to State of the Market. You know, with all of the madness surrounding GameStop, AMC, and the other heavily shorted stocks, I've been getting a lot of questions about short selling. Now, let's talk about what shorting actually is and how you do it. Now, most investors buy stocks. They buy low and hope to sell high. Shorting is the opposite of that. Shorting, you sell a stock first before you even own it, selling it high and hopefully buying it lower. Now, one of the reasons GameStop and the other stocks got so much attention is that not only did the stock soar, but the shorts got absolutely hammered, and a lot of people hate the shorts.
Short people got no reason. Short people got no reason to
Whoa. You can't say that in 2021. Honestly. Sorry about that. Now, more on why people hate shorts in a minute. But first, how do you sell a stock before you actually own it? To do that, you have to borrow shares. Now, your broker helps you do that. When you sell a stock short, your broker will find the shares either in its own inventory from its existing customers, or it will go out into the marketplace to find you those shares. And once it does, you can sell the stock and collect the funds. Remember, the shares are borrowed and no loans are free. You have to pay interest on those borrowed shares, and the interest rate will depend on a variety of factors, including which stock you're selling short. And the rate can change from day to day. So you may pay as little as a few percentage points annually to well into the high double digits. So if you're shorting a stock, make sure you understand what interest rate you're paying and keep track of it often. Now, you'll need a margin account to be able to short stocks. So talk to your broker about how to get started. It's actually quite easy. Now, let's look at a few scenarios of shorting. Let's say you sell short 100 shares of stock at $20. You'll receive $2,000 into your account and begin paying interest. A few months later, the stock is trading at $10 and you decide to exit the position, also known as covering your short. To do that, you buy the stock, which allows you to return the borrowed shares, and that will cost you $1,000 because you're buying 100 shares at $10 a piece. So you sold high and you bought low. You sold $2,000 worth of stock short and you bought it back for $1,000. So you have $1,000 profit minus any interest and commissions. Now, here's an example of a short that goes horribly, terribly wrong. Let's say you short that 100 shares at $20, but instead of dropping to 10, it rises to 50. Now, at that point, you can't take the pain any longer and you cover your position. So now you've sold $2,000 worth of stock short, but you've had to buy back $5,000. So you've lost $3,000 plus interest and commission. Now, this is the big risk with shorting. You have unlimited risk. So if you short a stock at $20, the most you can make is $20 per share because the stock can only fall to zero. But your risk is unlimited. The stock could go on forever. It could go to $50, $100, $300. And that's exactly what happened with GameStop. It was a very heavily shorted stock. So it was trading at around $20. And then a few weeks later, it hit a high of $483. So anyone who was short 100 shares at $20 had a paper loss of over $46,000. And hedge funds that were short a lot more than 100 shares. They lost millions and in some cases billions of dollars. Now, because the risk is unlimited, my preferred trade, if I think a stock is going down, rather than shorting it, is to buy put options. Now, options come with their own risk, including the fact that they expire and the prices decay as they get closer to expiration. But the most you can lose on a put option is 100% of your investment. Whereas, as you saw with GameStop, you can lose many, many times your investment if you're short a stock. Now, another thing to be careful about, stocks go up over the long term, and they're up 65% of any given month over the past 100 years. So if you're going to be short, you're going against the tide. You need to have a strong reason why you expect the stock to go lower. Now, one last thing, some people think that shorting stocks is un-American. Now, that is garbage. Was detecting and warning about the frauds at Enron and Valiant Pharmaceuticals and mortgage-backed securities un-American? Short sellers were the ones that brought those frauds to light. Short sellers typically conduct very thorough research. Now, they're not always right, but their opinions are usually worth considering. And they're typically not short quality companies hoping they'll implode. They're not looking for the economy to tank. They short companies that are suspected frauds or that have some serious deficiencies and are way overvalued in their opinions. Now, markets consist of buyers and sellers. Short sellers have every right to place a bet on their thesis that a stock is going to go lower, just as much as a buyer has a right to place a bet on their analysis that a stock is going higher. That's called a free market. Short selling isn't for everyone. You need to understand and be able to handle the risks, but it can be an effective way to make money in a bear market, to hedge your portfolio, or just bet on a stock you expect to head lower. Now, next week, be sure to check back here when I analyze the 3 highest yielding stocks in the market. You won't want to miss that. So just click on subscribe up above so you don't miss that. And you can also check out my free e-letter, Wealthy Retirement, where all week long I talk about wealth and income building ideas. Just click on the link below to get started. I'm Mark Lichtenfeld. Thanks for watching. I'll see you next week.